Well, hello everyone. Welcome back to 2023. We've got our second season of the Cut. My name's Simon Cathro. I'm the managing principal of Cathro and Partners. Last year was a very successful season. We had a number of guests, and we're kicking it off with our favourite guest, our own banker, and our the commentator Martin Lakos. So I'll give a bit of an overview for Martin. How are you, Martin?
Simon, g'day. Thanks very much for having me on today.
That's great. Well, just by way of background, I'll just read out Martin's background for everyone's interest. Martin has been one of Macquarie's leading media spokesperson for more than 15 years, being a regular economic and market commentator on all major Australian networks, as well as CNBC Asia and Bloomberg. He's known for his ability to clearly explain complex economic issues and market trends, and Martin is passionate about a broad spectrum of issues and can confidently address an extensive range of topics from big picture macroeconomics and current trends to interest rates, investor strategy, and what's happening in the key global markets. He often gives presentations or facilitates panel discussions at conferences around Australia, and he has literally grown up in the finance industry where he's worked for the school holiday pocket money. I like that. And Martin has always been fascinated by the economy and investment markets, and he has a financial career spanning 40 years, where he started on the Australian Stock Exchange in 1979 and held roles in Macquarie since 1994, including heading up the Asia Institutional Sales Desk and being appointed Divisional Director of Macquarie Bank in 2006. When he's not addressing conferences or media, Martin is a senior investment advisor with Macquarie, advising clients and their families on a full range of wealth strategy. And he devotes his spare time to not-for-profit groups and is a board member for the George Gregan Foundation. He has also spent 9 years on the Juvenile Diabetes Foundation Corporate Fund, raising committee with 3 as chairman, and has an MC as the Gala Ball event. So, Martin, thank you for joining us. What a history! Fantastic.
It's a bit verbose. It's a bit it's marketing speak. But I suppose when we look back on my career, we've all done lots of good stuff, I hope.
Yeah, look, what it doesn't say is that you're an extremely healthy person for someone that's been working for 40 years. You look like you've been around for about 10 years. So it's good you maintain. So for us, it's.
Can you pass it on to my wife, please, and just.
I will do that. Not a problem, Martin. Not a problem. But yeah, look, I mean, for our viewers and the people watching our podcast, we focus on areas of restructuring and insolvency. And I think before we get into some of those questions, we want to sort of get an overview on where we think the economy is going to head. It's been an interesting 3 years. To say that we have had trouble trying to predict what was happening in the last 3 years for our industry is an understatement. I don't think anyone in our industry has predicted rightly what was about to happen in terms of the amount or the low amount of insolvency work that we saw in our industry since COVID kicked in. But going forward now, we're back to a normal, much more normal economy. Things are really starting to ramp up in terms of normalisation, if you want to call it. But how do you see sort of this year and potentially next year looking like for the economy?
Simon, I guess for us, and without sort of going through what we've just gone through in the last 3 years, but 2022 was an interesting year because obviously we had the change of the cycle, what we call a transition year, and quite clearly central banks basically got it wrong, got the timing wrong in terms of when they need to raise rates. And right through 22, they've been playing catch up, raising rates. And historically we haven't seen the rate and pace before. 8 rate rises in Australia, about the same in the US. But for good reason, because quite clearly with inflation where it's been and probably where it's going to hold for a while, the central banks had to address this very, very quickly. So there's all sorts of ramifications. What we did find is that when we look at 2022 as compared to how we think 23 is going to pan out, global financial markets were extremely volatile through that transition. That is when interest rates are starting to rise. But the economic data, which is often lagged, was still relatively strong, in terms of growth terms, in terms, for example, here in Australia, even retail sales have been holding up really, really well. consumer or business confidence has been a lot better than we'd thought. Certainly the business or part of that survey around business conditions was holding up a lot better. We think those things are basically going to reverse in 23. So we think that global financial markets have accounted for a lot of the negative news. Sure, there's still some risks out there, there's no doubt about that, but probably we're going to see better performances in the latter half of this year from global financial markets looking forward. But now we're going to start seeing that lagged effect, and we'll start seeing the economic data really starting to show that economies are slowing, if not stalling. Yes, we will see inflation in the data terms coming down, which we've already started to see in the US, but not quite here. So almost a role reversal from 22 into 23. I guess the key risk has got to be whether central banks can make a mistake again, and that's very, very possible. And what do we mean by that? Well, not so much that what we think the peak will be of interest rates, but what's the duration by which they'll keep rates at these higher levels. And that really is going to be structured around the inflation data. Now, we are definitely seeing inflation starting to soften in the United States, and there's plenty of anecdotal evidence that I can go into a little bit later on that would suggest that inflation probably has peaked around the world. But there's a lag on this, even here in Australia. But the question is, how long does inflation remain above the target ranges? So the central banks basically set targets to where they'd like to manage inflation. And the US central bank is targeting 2%. And yet you've got inflation around 6.5, 6.8. Here in Australia, the Reserve Bank is targeting 2 to 3%. And our latest data has got the inflation rate at 7.8. So we've got a long way to go before that inflation data falls back into those ranges by which central banks are a lot more comfortable. So it may well be that this year is the year that we have rates at for a much longer period at their peak. Now, what does the peak mean? Well, certainly we think that the central bank in the US is probably going to peak around 5. That's their cash rate. We're currently at 4.5 to 4.75, so we're nearly there in terms of Macquarie's view. As far as Australia is concerned, we are expecting the Reserve Bank to raise rates at its next meeting for February, which is next Tuesday, by 25 basis points, and that'll take the Australian cash rate to 3.35%. Now, Macquarie's view is that will be the peak. However, the risk is that we don't see inflation coming down fast enough. And that's in particular driven around the wages story. So wages growth, which has been very necessary for households to see wages keep up with the cost of living. But while we're going through this wages growth recovery, that's going to continue to put pressure on the CPI data. And it may well be that the central bank here in Australia needs to go beyond 3.35%. And we see that as a risk on our base case. But at this stage, we're sticking with that data, that view at this point in time. So there's obviously a lot happening there. And then at the end of the day, businesses and consumers have got to deal with all this, deal with the rising costs that we've been seeing around the world. And in particular, what we really haven't yet seen in the data is the flow-on effect for the consumer. And what do I mean by that? Well, there's no question that consumer confidence has deteriorated dramatically. In fact, it's been at one point in time the worst since we've seen at the time of the GFC. But during the same survey period, retail sales were going up, which is quite extraordinary. So consumers and households are saying, gee, I feel really bad about the outlook. Hey, let's have some retail therapy and go and spend some more money. What we think is probably going to happen is we'll start to see those numbers come off. So those businesses that are directly exposed to consumer discretionary spending will start to feel that in the first half of this year. Equally so, the gap between the surveys of business confidence and business conditions, between that and consumer confidence or household confidence, is the widest it's been in 40 years. In other words, although the environment is slowing and interest rates are going up and costs are rising for businesses, business confidence has not collapsed like it has for the consumer. And business conditions, as per the most recent surveys, again, is okay. It's just turned slightly negative, but again, it's not collapsing. So it would suggest that businesses are going into this transition period probably in a reasonably healthy position from a balance sheet perspective, And right through COVID, we know the evidence is there that businesses had the opportunity to start to cut costs. But that only lasts so long. And depending on that duration piece that I was mentioning in my opening remarks around inflation, the longer that we have this cycle extended, it means business is going to come under more pressure in the latter part of this year. So that's sort of the big picture side. There's other risks out there that we need to take into account. There's no doubt there's geopolitical risks as well that can impact both sentiment and activity. If I were to say in terms of, we'll talk about inflation, we think the risks on inflation are starting to ease somewhat, but we're not really going to see that coming through to the data until about the middle of this year. What are the sort of things that make up inflation or CPI that's suggesting that? Well, the key one's got to be, one of the key ones has definitely got to be energy prices. So again, we don't get much in the media about this, but the oil price was $120 a barrel. It's now 78.
Yeah.
Gas prices around the world have come off substantially. So the cost of energy is definitely declining, or has declined, and is starting to feed through. And although we're getting plenty of rhetoric that the recent policy decision by the government on capping energy prices is having the effect, to be quite honest with you, it's a global market price. It's coming down in reality. Equally so, supply chain disruption, which was very much putting cost pressures on the upside and flowing through into inflation, is very much coming off now. In other words, markets and supply chains are opening up. A couple of pieces of anecdotal evidence I can give you. The cost of a container that basically went up 4 times through COVID is basically back to where it was pre-COVID. So we've seen this massive spike in the cost of shipping, and it's basically now returned to back where it was on a pre-COVID basis. Many of the input costs outside of energy for manufacturing around the world have also come off. So you're now finding that inventory control is starting to return to more normalised levels. But it does take quite some time for that to really feed through to those consumer pricing of goods, and that's going to again flow through to the middle of this year.
On the lots to take in there, but on the interest rates, if we start there, there's a good percentage of borrowers that have fixed home loans, and from what I understand, at some point this year, I thought it might have been April, May, might be a different date, where there's a good chunk coming off, and then they'll be exposed to what those variable borrowers are already experiencing, a big increase in their repayments. Do you see any impact in that sense? And what's your sort of information in that? Is there a big chunk coming in April, May, or a different date?
No, look, it's probably going to start to flow off those fixed term mortgage rates around April, and about 12 to 15% of the total loan book will probably revert back to variable rates, and therefore households will have to deal with a much higher variable rate than what they're enjoying on fixed. Certainly, there's a pricing gap. I mean, it's not as if mortgages were zero. Fixed rate mortgages were only between 2.5% and 3% anyway, but they're going to go to 5%, or around that. So there is some additional pressure, without a doubt, on some households. But we think that because the process by which rolling off the fixed rates is going to probably take over the next 12 to 18 months. It's basically spread across the loan book, and it's probably somewhere around about 40% of the total loan book. But many households have fixed only a portion of their mortgages, so they often were running what we call a cocktail. So some variable and some fixed. There'll be some households that are all fixed, and they'll be feeling the pain a lot more. There's no question that that on our numbers, when we look at the percentage of household income that is allocated to paying the mortgage, it's going up, quite obviously. But it's only taking us back to the 2013 period. And so you have to ask, how distressed were households in 2013? Yes, cost pressures were up because interest rates were higher then. But did we have a recession in 2013? Did we have a housing collapse in 2013? And the answer is no to both those questions. So not taking away the fact that households will be feeling the pressure, and the way they'll deal with that is obviously reducing their discretionary spend, and they'll be drawing on savings. We think that households should be able to manage this situation. It's not that long ago, just before the GFC, cash rates were well in excess of 8%. We're talking about cash rates peaking at 3.35. They may go to 3.7, but somewhere around there. So again, we need to put that in perspective. And it's not that we haven't had wage rises since 2013. We clearly have as well. I guess the other thing that COVID has assisted in all of this is that right through when we had cash rates virtually at zero, household savings ratio went up dramatically. So households were able to save money. They weren't spending as much, they weren't travelling, they weren't spending on hospitality. And so coming out of COVID 12 months ago, there was clearly a buffer in the average household balance sheet. Now that is being whittled away. No question about that, and it won't last forever. Equally so, with low interest rates, if households were maintaining their standard payment, the part of that payment which went to interest versus principal enlarged quite dramatically on the principal side. So again, coming out of COVID, households had basically about a 20-month ahead of payments from a principal perspective. Now again, that's starting to whittle away. So again, households are in an okay shape, but the longer that we have higher interest rates, clearly those statistics around that buffer will start to erode.
I think one comment I get from that response is the size of the typical home loan in 2013 to today. Is that quite substantially different, or is it in terms of actual dollars? So, for instance, if I go out and borrow $500,000 versus today, I might be borrowing $1 million simply because the price of property has gone, up quite substantially. That must factor into your available cash, because if the wage growth has not gone up as quick as the price of property, which I think is right, the loan naturally itself would have to go up too, in proportion to the value of
the size of the average loan has clearly gone up, basically aligned with how property prices have moved. Because obviously the value of property that's gone up, and people buying property through COVID were paying those higher prices quite clearly. So the average loan size has definitely gone up with the average, pricing of home. I think the median house price in Sydney is about $1 million. So the answer is yes, quite clearly the size of the loan has gone up, and yet wages haven't gone up as much as in proportion. So that means a larger proportion of that discretionary spend allocated to paying off the mortgage has also increased, for sure. And that's where we're going to see some pressure on the household budget, definitely.
Yeah. The other one that sort of comes to mind is the cost of living. Like, just personally, I just look at how much I spend just on groceries and things like that, and the increase has been quite substantial. I literally almost ordered the same food that I ordered 12 months ago, and my monthly spend has gone up 20-30%.
Yeah.
So that's where I sort of see the combination of the increase in the interest rate plus the increase in the cost of living really coming to a head on a personal level. On the corporate front, the insolvencies dropped off about 70% during the COVID. We saw a pickup around about August last year, where we started to see the insolvency numbers start to normalise compared to pre-COVID numbers. And we get a lot of information from our industry body, ARETA. And then it sort of started to dip back again, sort of towards the end of last year and the beginning of this year, where we're not seeing the number of appointments be similar to that pre-COVID in the same period. So, we're a little bit perplexed about that. Our inquiry rates are definitely picking up in terms of insolvency and distress, but I still feel like there's a big catch-up. You have a normal percentage of insolvency appointments in an economy, and whether it's 1%, 2%, whatever that percentage, it was down 70% from its normal numbers. So that means that there were 70% of these businesses that generally fail because of the fact that there are poor management. Most of the reasons why insolvency happen is because of poor management, nothing else. Not because an industry disappears. I mean, that's a rarity, but it happens, right? It's simply, but it's more in slow motion when there's an industry shift, right? And so generally speaking, either most businesses pivot and evolve, and then you'll have those that suffer. But the ones that suffer are the ones that suffer because of the fact that there's been poor management. So most of the ones, when we do our investigations, suggest that insolvency is caused by poor management. But we haven't seen that pickup or that catch up that we were expecting. And I suppose, I'm not. This is more a statement rather than a question. But I do think that things for the insolvency industry should pick up to get the economy back to what it was pre-COVID and in line with sort of the normal economic factors that we tend to rely on and hear about.
I don't profess to be an insolvency expert like yourself, Simon, but some of the data we've seen is exactly what you've just said. It looked like more a normal insolvency cycle starting to move through 22. Haven't seen any recent data since the end of last year. But I think to some extent, anecdotally, it makes some sense when you think about it, that with costs rising, we certainly know that some of those biggest costs for many businesses are obviously things like energy, clearly things like the cost of employing staff, whether it's professionals or support staff across a range of either professional services. It clearly has been going up for quite some time. So there's no question that costs are definitely rising. What we are also seeing is quite obviously a number of industries are already coming under pressure. Construction, development, that's an obvious one, making the headlines. We're more likely to see in the latter part of this year some areas of retail that are exposed to discretionary retail coming off, and that'll just be aligned with how household spending will start to change through this year. But I guess to some extent, what's been really interesting, and I think it's a factor like we're seeing through the consumer and how long businesses can hang on. They did a lot of work through COVID in terms of cutting costs. They got the advantage of lower interest rates on their balance sheet. And so, how long does that cost-cutting process last for them, given an environment which is seeing costs rise quite dramatically? So I think you'd expect to see, again, that lagged effect start to come through in the solvency in the latter part of this year. But I think to some extent, we've also got to put this in perspective. In terms of the broad economy, we're not expecting a recession in Australia. So we're not expecting to see that massive rebalancing that a recession is, but we are definitely going to see the economy slow or stall through this year until we get to the point where we start seeing interest rates actually starting to come down. That is where the Reserve Bank feels comfortable enough that the inflation rate is making enough movement on the downside. They don't want to push the economy into recession if they can avoid it. And it may well be that we see interest rates start being cut by the end of this year or early 24. And that will start driving more positive sentiment for business in terms of investment, business activity, employment, all those sorts of things. So, I hate to say that I don't think we're going to see a massive decline in the economy that would also see a significant rise in administrations and insolvencies. But clearly there are some industries that are going to be under the pump this year.
Yeah. When we compare countries, and you look at the United States and UK, I suppose, are the ones that we typically look at, are there? We're a bit behind. Like there's a bit of a lag, isn't there, between what we experience to what we're seeing over in the US and UK. And if I take it from a layman's perspective, you look at how hard the US and the UK have gone in terms of their interest rate rises. It's much harder than what we've done here in Australia. I suppose the two questions coming out of that is, is the lag, do we have any visibility on what that lag is? Is there no lag? Is it 3 months? Is it 6 months? And secondly, do you think that our approach around the interest rates has been right for our economy? I mean, clearly not as aggressive as what the US and the UK have done.
Well, look, there generally tends to be a bit of a lag. Whether it's 3 to 6 months, it depends on each cycle. It is different every cycle. It also depends where we're coming from. So the Australian economy was far more resilient through the pandemic than other economies. And that was, to some extent, was either a factor of our economic, how we were going into the pandemic from an economic strength perspective, and then how deep our shutdown and lockdown process was. And Australia was pretty deep in terms of the lockdowns. But then the offset was quite clearly what the Australian government, the coalition government, did at the time in terms of supporting the economy, supporting businesses, supporting consumers. It was probably one of the most detailed and broad-brushed financial support of any major economy around the world, and certainly it varied from country to country. You didn't get the same depth and breadth of support in the United States that we did here. So we're very, very lucky to have had that. And so we came out of the pandemic in a much stronger position. Having said that, the US economy was pretty strong last year. Unemployment at 3.5%, and earnings growth, when you look at companies, was continuing to go up quarter on quarter. And interestingly enough, that earnings growth, although it's starting to now decline, it again hasn't yet collapsed. So companies are still making inroads on earnings, just not the same rate and pace that it was. When you talk about the UK, clearly they are being impacted by what's happening in the EU, although they're no longer part of it, but clearly they're still one of the big trading partners. And they've been hit much harder than a lot of the major economies on energy prices. Equally so, the UK did not come out of the pandemic in a strong position. They were barely seeing economic growth around 1.5%. In fact, since Brexit, they really haven't got their economy going. And yet we were tracking at 4.25% growth coming out of the pandemic, which was a factor of that stimulus package from the government and from the central bank. So again, I think we've got to be very careful in terms of how we're comparing economies and the cycle that we've just come from in that respect. And to some extent, that's one of the reasons why we think that Australia is actually in a pretty reasonable position not to go into recession, but to sort of muddle our way through this again. Whereas the US, the one big factor that's impacting the US is that they are currently going through a wages spiral. And that's really, really not good from an inflationary perspective, because the higher wages go up, that adds into inflation, which means the central bank has to keep rates higher. Higher rates also adds into the whole inflationary data. So you get the picture of what that spiral is all about. Hopefully that's under ways.
Yeah. Look, I mean, from my perspective, I think we will do better as an economy compared to other countries, in the sense that we've had a record year on agriculture last year. Mining is strong and possibly benefited from what's happening over in the Ukrainian conflict, and unemployment is still keeping quite low. And from a US perspective, there's been a record there's record low unemployment rate this month in January. So it's interesting to see where we're heading. The only other thing that probably adds to our view about insolvencies picking up is there does seem to be a lot of outstanding debt owed to the tax office, and big amounts of debt recoveries are still yet to sort of get into their full swing. I mean, the ATO has told our industry that the second half of this year we'll see a lot of more enforcement. To give you some perspective, the ATO was the largest creditor to make winding up applications in court. For obvious reasons, they would make 10, 20 every single day. We might be lucky to see 2 or 3. So we're still not seeing that enforcement of winding ups at pre-COVID levels. What we did see is the ATO take a different approach and issue direct penalty notices in a very extensive way. I think in the second quarter of last year, and that makes the actual directors personally liable for those debts. So we don't know the exact number of those companies or those individuals that didn't comply with it and are now personally liable for their debt, and they're just waiting for some sort of enforcement to happen. Just coming back on the industries that we might be impacted by, the hospitality and retail. I suppose if we think back to the GFC, there was a number of retailers that did fall over. Do you think we're just going to see a softening of the actual retail numbers, or we are definitely going to see some really concern, and both hospitality as well. I mean, hospitality tends to be smaller businesses in that sense. I mean, accommodations there, but you talk about your restaurants and cafes. I mean, they're small businesses where retail's a mixture of big and small. Do you think we're going to see, if we are going to see some sort of softening, it's just going to be probably not very severe, but less so, and we'll just see maybe a bit more of a rationalisation, maybe by retail in what they offer or number of stores, or do you think we will see a big pickup in insolvency for those industries?
Yeah, look, I think what we clearly saw through 2022 was huge, COVID pent-up demand to get out and do stuff, travel, spend money on hospitality, spend money on some goods as well. And that probably is starting to level out. When you look at, for example, the credit card data of spending, it really has returned to what we call normal. No surprise, through the lockdowns, there's a huge amount of spending on goods on the internet, and services and hospitality basically saw a dramatic fall off in spend. We've now seen that reverse. So services, hospitality, tourism have actually been doing pretty well through 22. But you would think that the higher interest rates, what we've talked about in terms of more pressure on households from a cost of living perspective and higher mortgage rates, they'll be reining in their spending. Where will they rein in that spending? I think it's more likely to be on the goods spending initially than on the services spending. You've already seen the impact of COVID, particularly around your central business districts, on restaurants and the smaller cafes. We've seen shutdowns of those businesses. I'm not so sure we're going to see as much of a dramatic impact on the local cafes and local restaurants. It does appear there's been a shift over the last couple of years to be supporting local. But I do think the value and volume of spend will start to come off. And it just really depends what precarious position are those businesses in. In the area that I live in, and quite admittedly, it's an area where there's a high discretionary income. Cafes are still booming, restaurants are still booming. It's quite extraordinary. But I think if you run around any part of Sydney that I live in, you're almost seeing that. So despite the slowdown and the prospects of a slowing economy and rising costs, that feel-good factor for consumers, I think, is still somewhat there, but maybe less so from COVID. So I'm not sure I'd be expecting a dramatic fall-off in activity and hence a dramatic rise in insolvencies. But I think there'll be some businesses that were hanging on by the skin of their teeth through COVID. They got thrown a lifeline because of the policy support, and how long can they last? Maybe the issue, and so you would expect to see some increase through the first half of this year. But again, it just doesn't feel like there's going to be a collapse here, but definitely a softening.
Yeah, great. Well, Martin, thanks for joining our podcast and being our first guest for the year. Before we wrap up, is there any final comments that you wanted to make with respect to what we're going to see in the next couple of years?
Yeah, look, I think there's clearly some key things to be thinking about. Certainly, for this year, we think it's going to be a year of two halves, where it is going to soften in the first half, and the data will look more negative than it was in the second half of last year. We are expecting to see things bottoming out by the second half of this year, and as I mentioned before, there is the opportunity. There may be the prospect of the Reserve Bank starting to consider even cutting rates. At the very least, we won't see ongoing rate rises. So I think that will add to some confidence in the economy. It's probably the thing you don't want to hear, Simon, from your business perspective. But it's not a disaster scenario, but it is definitely a slowing and softening scenario through 2023. And then we are looking for some modest pickup into 24. So, it's an okay scenario, maybe even a muddle through scenario, but it's not a boom scenario. One thing that I think we need to put in perspective is that Australia has been doing extraordinarily well, and you touched on it very briefly. The mining sector has done particularly well. That's also dramatically increased the tax take into for the federal government's coffers. So the country's total debt is actually in a much better position from a government debt perspective than had been thought of at this stage. which may allow the government, maybe not in this May budget, but in updates, it may be able to increase some spending, and that will support the economy as well. And the last thing I'll just touch on, obviously China is very, very key to the Australian economy, not only its usage of commodities, but from a regional and a global perspective. There is certainly some signs that the Chinese are now really starting to ramp up their support of their economy, having basically shifted or pivoted very, very quickly away from the zero COVID policy. So that will also aid some support for the global economy, and Australia will benefit from that as well. So that, to some extent, adds into that story that we have, that it's not an entire collapse through this year.
Great. Well, fascinating. We could talk all day, but thank you, Martin. Thank you for joining us for our first episode of 2023. And for those watching, Macquarie Bank supports the accounting industry significantly. They are a leading banker in that space, and we do thank Martin and his team for taking the time to join us today and be part of the podcast. But thank you very much, Martin, and thank you, everyone, and have a good day, and we'll see you in a month's time for our second episode.
Thanks, Simon.